From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, the latest payrolls report coming in hotter than expected, sending Treasury yields surging with the Fed's next move in focus. Traders slashing their rate cut bets, pricing out a 50 basis point move in November. And we begin with the big issue, an upside surprise in payrolls.
This is, across the board, a very strong report.
These numbers are pretty staggering.
It's a solid print.
This is not just a solid labor market, but if you take these numbers at face value, it's a strong labor market late in the cycle.
The labor market has so much attention focused on it.
The Fed's laser focused on the labor market.
So it's a labor market that looks okay.
Good news is good news here.
For the Fed, it means push back much harder against pressure from the markets to put you in the single mandate box.
This is not as tight of a Fed as the market, or really as the Fed thinks it is.
It makes sense for the Fed to be cutting, right?
We've seen a repricing of the market for the next Fed meeting. The idea of 50 basis points has been reduced.
Probably 50 basis points is off the table for the next meeting.
Going forward, I think the next one is going to be really important.
It's all in the mosaic of the jobs data.
Last night, the concern was we're headed for a recession. Now the concern is no landing. It's probably somewhere in between.
Now, I want to hone in here on the tremendous volatility we have seen in the 10-year yield, because just this week, on October 1st, you were below that 3.7% mark. Yet you have risen so far, so fast, and now we are flirting with 4% once again. And this is all as traders reprice their expectations about Fed rate cuts and what is possible after we have seen such strong economic data, particularly in the job market. Now, I want to flip up the board here, because even without that 50 basis point cut, you have seen with it rather, that was earlier this week, but putting price out of the next move here, you have many investors really looking forward to perhaps a mistake that was made by the Fed, at least according to billionaire investor Stan Druckenmiller and former Treasury Secretary Larry Summers. Now, Druckenmiller had told me earlier today that he's now concerned that the Fed has boxed itself into a corner, saying this: "I hope that the Fed is not trapped by forward guidance the way they were in 2021. GDP above trend, corporate profits strong, equities at all-time highs, credit very tight, and gold at new highs. Where's the restriction?" he asks. Now, Bloomberg's Michael McKee caught up with Chicago Fed President Austin Goolsbee, and here's what he had to say.
This jobs number today and the whole report is a superb report. You really couldn't ask realistically for a better report for the economy. As a central bank, you don't want to react too much to 1 month's report. If we get more reports like this, as I say, I think we should have more confidence that we are in fact settling in at the landing spot that we want from a dual mandate perspective.
Joining us now, Tannuzzo of Columbia Threadneedle and Robert Tipp of PGIM Fixed Income. And even if both of you believe that 50 was necessary in the last interest rate cut meeting, in the last FOMC meeting, you're looking at Fed swaps now, and you have traders actually pricing in less than a 25 basis point cut in the next meeting. Pretty remarkable after the data. What does all of this recalibration in the jobs market really mean for you, Robert, on the path ahead for interest rate cuts?
Sure, yeah. I don't think the Fed has boxed themselves in. I think that, they kicked off with a 50 basis point move. It was justified for the data they had at that time. They are way in restrictive territory. That gives them the latitude to wait, to be more cautious in the next step. And as we're seeing with the data yesterday, today, the day before, there's been some improvement. And so, I think this gives them the time to wait. If it is low inflation numbers that we get the next couple of months, they could keep cutting in order to sustain this outcome that they're getting with the economy, because this is what they want, is a stable unemployment or falling unemployment rate. They don't want it rising. And you have to remember that just a few months ago, and for a handful of months running, they had a rising unemployment rate. At that point, it looked like they needed to bend the line. They needed to get it from going up to going down. So that kickoff with 50 basis points made a lot of sense. But now they have the flexibility to go at a more cautious pace, reevaluate with the data. If they need to reaccelerate again on the moves, they can do it. They don't need to do it right now.
Gene, how do you feel the Fed is going to move forward from here? You have the market essentially pricing in pretty much 25 basis points at the next two meetings, which would bring you to 50 basis points for the rest of the year. Do you believe that that's justified?
I do think that's justified, Sonali. And I think what we can see in these numbers is that the cutting cycle is not over, but the Fed doesn't have to be in a hurry. And if we look at total growth in non-farm payrolls, in 2021 and 2022, that was growing at or above 4%, which is a very robust level of growth for total jobs in the economy. That slowed to 2% in 2023, and over the last 12 months is about 1.5%. So the theme of a slowing and normalizing labor market is still very intact in these data, but we don't see a recession starting in September based on what we can see in this report.
You know, there remains to be a question about how hot this data really came in at the end of the day. The highest estimates for the payrolls report was 220,000. We came in more than 30,000 above that. So, Robert, you look at that, how much the beat was by, and also the fact that wages came in above expectations. Are parts of the economy almost still running too hot for what has been expected, for what is being factored into interest rate cuts here?
Right. Yeah. I mean, there are a lot of moving parts. I think that the surveys, the household survey has been showing strong growth in the labor force, and the job growth was not keeping pace with that, and that was creating slack. That's changed with this report, but that household survey is very volatile. And so, they'll really need to see another handful of months to get confidence that the unemployment rate has really turned and is going down. The numerator of that unemployment rate is taking into account the growth in the labor force, and there have been some changes in the immigration dynamics. So if you have a slower growth rate in the labor force, then you're going to be looking for a target of a slower rate of job growth in order to keep things in balance. So, I think all said, this is a good report. You saw reversals of some of the trends that were concerning in prior months, notably that rising unemployment rate from the household survey. So I don't think you can really take away from the value of this report as suggesting the Fed may be on course for a really good landing to this expansion at this point.
Gene, how did you feel about the report itself, the strength of the report? But I want to double down again on that wage point, because not only did wages come in better than expected in terms of the growth rate of wages, you also had that kind of moving forward, the issues around the port strike and higher wages embedded in those discussions between the union and employers here. So does that all mean that there is risk at the end of the day when it comes to wage inflation and what it means for the broader inflationary story?
I think there certainly is risk, but if we look again, zooming out at the bigger picture of wage growth, that continues to moderate, and broader measures of inflation, including wage inflation, show that we are normalizing back to a level of growth and inflation that's very similar to where we were pre-COVID. So if we're close to 4% unemployment, close to 2% inflation, that's very close to a 2017, 2018 economy. The difference is short-term interest rates are 300 basis points higher. And I think that's what the Fed is recognizing here. And if we look at their longer-term center of gravity and their message, they think an economy that looks like this with those longer-term economic variables warrants short-term interest rates closer to 3%. And that's why we're on this cutting path, is that they're trying to sustain this. It's not that they want to make a change to the economy, they want to sustain the economy. I think that's the right path. And then, whether or not there's a recession is a whole nother argument. So I do think wage growth very narrowly in a 3 to 4% type range is consistent with overall inflation within line of the Fed's 2% mandate.
Robert, where do you think the neutral rate is? Because that is a discussion, of course, that comes back to the surface after you saw what you saw today and after you see the whole market really recalibrating what things look like longer term.
Yeah, I mean, I'm almost going to beg off on that one, because I think the central banks have a lot of leeway in terms of where they establish their idea of neutral, and that the economy is going to run efficiently and find an equilibrium that makes some sense, even if they are really off by a couple percentage points on that equilibrium rate. I think that central banks around the world prior to COVID ran interest rates much lower than they needed to. That risks creating imbalances, and that always is a risk going forward. I think, though, that we are in a different situation now than we were before COVID. It's true, hourly earnings are not far away from where they were. The ECI is up about 1.5% from those levels, though, the Employment Cost Index. And workers have lost a lot of real purchasing power, and prices are high. And these inflation measures aren't inflation itself. They may be understating the degree of inflation that people have experienced. So I think that, the Fed will need to be watchful still, even though it's a low probability, of a miniature replay of the 1970s. This is exactly what happened in the sense that there was an oil price shock, which we had during COVID, on the upside, high inflation, aggressive central bank reaction, which we had to the 73 oil shock. Inflation came down, the economy slowed quite a bit, and the Fed began to cut. And that's where we are now. That's where we are in Europe. If you have an acceleration in growth and or just a shock in energy prices that pushes inflation up to a high level, you will have workers looking to get higher wages. So, I think we are in a great spot. I think we are in a bull market for bonds. I think there'll be some two-way risk, though. It's not going to be easy call here. And, even that kind of a tail scenario needs to be watched out for, given what's going on in the Middle East and given the firmness in the economy.
We have to leave it there, but really searching for that neutral rate is soul searching, really. Jean Tannuzzo of Columbia Threadneedle and Robert Tipp of PGIM Fixed Income. Thank you very much for your time, of course, on a complicated day of jobs numbers and a lot of changes in thinking on the path forward. Now up next, the auction block companies and governments around the globe sold over $600 billion of bonds last month, and that's the most for a September on record. We're going to talk about credit markets next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where we wrapped up a record month for bond sales. We'll start in U.S. investment grade. We saw firms like Accenture, Dell, and Alaska Air lead the way with sales this week. The total, though, fell short of forecast with only $16 billion worth of deals. Now, when it comes to high-grade forecasts for October, we do expect a big slowdown from the $170 billion sold in September. Sales, though, are still expected to be strong, topping the average from the last 6 years. And in high yield, more than 50 borrowers inundated the primary market in September, leading to the busiest month in 3 years. October has also gotten off to a solid start, with the total already exceeding all of October of 2022. Speaking of credit, Tony Rodriguez from Nuveen Asset Management spoke this week about the fundamentals.
We're seeing the equity-like response in the credit markets, right? So emerging markets are doing well, preferreds are doing well, high yields doing well. So credit risk is highly valued right now, and the fundamentals are very solid. Defaults are low, corporate profits are good. So you're seeing the same story in the fixed income market. It's just that it's focused on the credit sectors.
Let's now bring in Mike Best, high yield portfolio manager at Barings, and Maureen O'Connor, global head of high grade debt syndicate at Wells Fargo. And Maureen, maybe after we've gotten more information, give us a recalibration here on how investors and issuers are thinking about tapping the market now that we've seen that jobs report and rates just fly higher.
Yeah, well, I mean, I think when you think about it from an investor's perspective, we're at a point in the market where good news is good news for credit markets and for risk assets more broadly. But specific to credit, obviously as rates sell off, it should be accretive to spreads over time. And we're seeing that today. Spreads are tightening, and we're back down to what are effectively 2-year tights in investment grade and close to decade tights in high yield markets. I think the question is how much further we can run from here. But ultimately, the story that's really persisted through much of this year is that elevated yields have supported some very lofty valuations in credit markets, and it's likely to continue. From an issuer's perspective, obviously, you've seen your cost of debt capital rise a little bit on the back of this number. But remember, we were sitting in the high 4s in 10-year yields back in mid-April. So we have come down a fair amount off of the peaks, and we still have some very large maturity towers in 25 and 26 that need to get addressed. So I think issuance is probably still going to run run pretty hot here in the near term.
We're going to talk more about issuance in a second. Mike, I want to kind of get back to that idea about higher rates here, or at least higher than the market initially expected. Just taking one example, for example, you had an airline today kind of come out and say that they are having issuers reaching agreement with creditors. And it's interesting to see such large circumstances in the market start to reach ahead. And I'm wondering what the read-through is across the market when you look at high-grade, kind of weaker borrowers. If rates stay this level or even marginally lower, let's say 50 basis points through the end of the year, are we going to see more stress?
Yeah, I think it's a great question. And I think by and large, what we've looked at in the more stressed part of our market in high yield is that the same companies that were having problems 2 years ago in 2022, and you could look forward and say rate cuts or rate hikes rather were going to be bad for them. It's still the same cohort of people. You know, obviously there was an airline today. They've been having problems. They've certainly been trying to merge in order to find a dance partner, so to speak, to move that company forward. But ultimately, you know, at the margin, rate cuts, and whether or not it's, you know, obviously the market was pricing in 250 basis points of cuts through the end of next year just a few days ago, and now we're obviously a lot lower than that in terms of the number of rate cuts. It's still on the margin, probably helps a couple borrowers that really haven't seen the growth and haven't grown into their capital structures. But we think that the default cycle is going to be a little bit longer this time, and it's probably going to last, you know, 1 or 2 years in order to clean out a lot of the transactions that happened in 21 and early 2022.
Fascinating. That airline, of course, is Spirit Airlines, and it would be forced into bankruptcy without a deal. And it draws an interesting question. If you're worried about a longer default cycle, if you're worried about more bankruptcies, how much flocking to safety do you see from investors, Maureen? Is that going to push spreads tighter for the safer stuff in the market?
Well, you could argue right now that investment grade actually screens a little bit cheap to high yield, just given the compression that we've already seen across the rating spectrum and across the two asset classes. You know, if anything, a stronger economic conditions usually argue for the opposite. You see more compression rather than decompression, what you're alluding to. But we've seen idiosyncratic risk tick up in the investment grade market as well. When you think about some of the situations playing out in, you know, some parts of semiconductor space, in some of the autos. So there's definitely scenarios that are kind of percolating to the surface here as we remain in this kind of higher for longer environment. But, you know, ultimately, I think this move probably means more compression in the near term. And then as we start to flirt with stronger economic headwinds, which today, obviously, we didn't see in the data, then at that point, I think you probably do see more of a flight to quality bid.
It's fascinating. We've had investor after investor say spreads are going to widen, spreads are going to widen, and wait for that moment. And we've seen such strong data. Mike, to Maureen's point, with spreads as compressed as they are, and further compressed to a large degree, why buy?
Yeah, it's a great question, and one that a lot of investors ask us quite often right around here on the high yield bond market in particular. And I think the response to that is that if you look back historically, when the Fed enters a rate cutting cycle, and generally speaking, the expectation is not for a recession within the next year, spreads continue to compress from there on out, and they certainly do not widen. You know, most of the scenarios, economic scenarios, if you look back over the last 20 years in which spreads basically widened out in the face of a Fed sort of cutting cycle, that was because of very obvious events that were going to cause sort of a recession. Obviously, 2020's, you know, sort of COVID rate cutting cycle being what it was really to stave off a recession that was well known, well forecasted. So for us, we agree that compression, or at the very least, you know, flat rates for flat spreads for a while will probably be the base case, for us.
You mentioned a maturity wall a little earlier, Maureen. How big is that maturity wall for you? What does it mean about the type of supply that will come to the market? How fast does it come? And what's kind of the texture of the issuance here?
Yeah, so we have two big maturity years coming up. 2025 is about $850 billion in maturities, and 2026 is close to $1 trillion in size. You know, some of the 2025 tower has already been addressed. I think part of the statistics get a little bit skewed by the fact that issuers have pre-funded some debt, but have kept cash on balance sheet because cash is earning a lot of yield right now. But you know, we have big towers. Why? Because the market grew after COVID. In 2020 and 2021, those were our two biggest issuance years. If you issued 5-year paper in those years, it's coming coming due, so the market must stay larger because it grew after COVID. So, I think in all likelihood, these towers are going to continue to be large and refi needs will be there. The question is, if you look at the vintage of those coupons, they're quite low, right? So the incentive to take them out early as rates move higher obviously dissipates some, and that's what I think we'll see today. But I think issuers have also gotten their arms around the idea that we're probably not heading back to a 2% 10-year anytime soon. And when you do see these pockets where spreads are very tight and maybe you get a little bit of relief in rates, you pull that forward. And that was indeed a narrative that played out for a lot of this year.
You have like 30 seconds, Maureen, but that $1 trillion maturity mall in 2026, what is that made of?
It's about 50-50 corporates and financials. Like I said, it was a lot of 5-year paper that was issued back in 2021, so very low coupon debt. But the construct looks pretty similar to what you see supply-wise now. So I don't believe that our market will have trouble digesting the new issue volume on the back of it. The technicals are exceptionally firm.
Clearly, investors have been waiting to chomp at the bit here for new debt. $1 trillion is stunning to think about. That is Maureen O'Connor of Wells Fargo and Mike Best of Barings. Thank you both so very much. Happy Friday and happy weekend to you. But still ahead, the final spread the week ahead. A fresh read on U.S. CPI. Remember inflation? We're going to talk about that next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield, and it's time now for the final spread, the week ahead. Now, coming up, what we have on Monday is more Fed speak rolling out with Neel Kashkari, Raphael Bostic, and Alberto Musalem. We're going to hear from JP Morgan CEO Jamie Dimon on Tuesday, plus more Fed speak from Adriana Kugler, Raphael Bostic, and Susan Collins. And Wednesday, the latest FOMC minutes. Let's see how all of this changes the calculus. And we are also speaking to Citadel security leaders at the Global's Macro Forum in New York City. Much more people to weigh in here on the path of Fed rate cuts ahead. All eyes on the data on Thursday, U.S. CPI and jobless claims in the pipeline, plus New York Fed President John Williams. And Friday, more economic data, PPI and jobless claims. Finally, big banks kicking off earnings to close out the week. We're going to get results from JP Morgan and Wells Fargo. Let's see if they hold on to that NII. And for my final thought, let's look at those CPI estimates, because of course you expect a cooling of the data yet again. The year-over-year CPI at 2.3%. We're going to keep an eye on all of it for you. But from New York, that does it from us. Same time, same place next week. This was Real Yield, and this is Bloomberg.